the last part of the year. On cryptocurrencies, I know that most central banks would like us to not to use the name, the word of cryptocurrencies, but crypto assets, which is similar. And just think when we talk about cryptocurrencies, we talk about more generally crypto assets. Cryptocurrencies have been attracting a lot of attention over the last years, all the more as inflation has been surprisingly blowing up with an associated devaluation of traditional assets. Moreover, the SEC in the US opened the door for a change of mood on financial markets when it allowed the Bitcoin to be used as an asset to invest in more traditional products, inside more traditional products. But what is the true, effective, efficient, understandable, and shared rationale of the cryptocurrencies? Is it purely speculative, and one should expect its advantage to disappear at economic equilibrium over the long term? Or is it there over the longer term, present over the term, with its true diversifying and hedging properties? These questions are especially strategic and also and including for SCOR. For examining if cryptocurrencies truly matter, Stéphane Villeneuve, who coordinates the share of market risk and value creation at the Toulouse School of Economics, a share sponsored by SCOR, will present its work with Bruno Bier, who is professor at HEC, Hautes Études Commerciales in Paris, and Jean-Charles Rocher, who is a specialist of finance and professor at Toulouse School of Economics, and who wrote a book on the regulation of insurance that has been especially influential on the conception of Solvency II regulation. And the three of them are working on a research project on cryptocurrencies, and Stéphane will present the first conclusion, which are of the highest interest for us. Stéphane is professor of mathematics at the Toulouse School of Economics. His research focuses on stochastic methods in finance and their application for dynamic contracting. Of course, Stéphane has a deep insight since long on the economics of risk and insurance, and some of you have already been participating to workshops on behavior he has been organizing at SCOR. Stéphane, you will have the floor. Let us say for 40 to 60 minutes, up to you to choose. To the participant, let me ask you not to raise questions during the presentation, except if you have a pure material understanding question. The question will be asked at the end of the presentation. In any case, we will stop at 4 p.m. and no later, because we have to leave the room at Paris time, and therefore we have less than 1 hour and a half. Stéphane, the floor is yours.
Thank you, Philippe. Hello, everyone. So thank you for the invitation. That gives me the opportunity to present an ongoing research project, as Philippe explained, on the potential role of crypto money or crypto assets as a safe asset, which may appear counterintuitive because we all know how volatile is a crypto asset. So this is something that is quite interesting when you are highlighting a counterintuitive result. So this is the main reason why I'm here. I would like to do something. And first of all, I would like to clarify what is not behind this tempting title. It's, I have maybe some problem to share? Do you see the screen? Do you see the... good. Sorry. So first of all, I would like to clarify this, what is not behind this title. This presentation will not provide any clues as to the price of Bitcoin tomorrow or the likelihood of a crash in the bubble if you believe that crypto is a bubble. No, it's more an attempt to explain this counterintuitive result, how private money, how crypto asset can substitute for central bank money in some cases. So as Philippe explained, it's a ongoing research project with Bruno Bier from HEC and Jean-Charles Rocher from TSE, which emerged from a more theoretical paper that has been funded by the SCOR Foundation for Science. I have to confess that I am a mathematician, so I will deliver an academic presentation. So I will present a model. I will present a model with all its simplifying assumptions that could be discussed after the talk, if you will. And as a model, it's just a way to describe something, some intuitions, some results in the easiest framework. So this is my objective. And I have to start with yes, so so it works like this. No, let me check this. Yes. So a little history. So the idea is to explain. So for instance, I will focus on Bitcoin because Bitcoin is maybe the most known, the well-known crypto asset. So I have to remind you that when it was introduced in 2009, people expected a revolution in the way individuals could access and control their money. But after 15 years, and regardless of scandal like frauds or technical problems, breakdowns, we have to admit that we are not even close. We do not. It's not the best way to buy bread, for instance, to use Bitcoins. And the questions that are natural is what are the reasons why Bitcoins or any other crypto assets or cryptocurrency have not been widely adopted. There are mainly two reasons. I think the first one, it's long. It takes a long time to buy something with Bitcoin, 10 minutes on average to validate a transaction. So it's not a practical way to spend money. And I have here, I should have proposed a figure, some figure, but unfortunately my subscription has expired. And so in this website, Statistica, you can see a figure that shows that on average, it's the average time to validate a transaction is very stable around 10 minutes. Unlike there have been a lot of technical improvement, this transaction time is very stable. And the other reason is about fees. It's very expensive. And once again, the transaction fees is very large when you plan to buy something with Bitcoin. So the question that we can ask is, okay, why can we imagine that cryptocurrency will compete with public money like dollar and euro? And to answer this question, the first things to do is to disentangle or to explain what are the main differences between the two types of assets. So what you know is that traditional currency are backed by institutions. So it's created by central bank and issued by commercial banks when they do loans. And what is very important also is that there is a legal obligation to accept them as a mean of payment, which is not the case for private crypto asset. And on the other hand, we have cryptocurrency that are created by internet network. distributed ledger. So it means that to pay someone, you have to send directly from one party to another without going through any financial institution. So the main difference is the standard public money is very, very, very centralized, backed by a very good by institutions, and cryptocurrency is very decentralized. So there is one major exception for the legal tender to Bitcoin. It's El Salvador. And the question that I ask is, can it work? Is that possible to see in the crypto asset not just a bubble, but something that could substitute for public money? So we have a very, very informed and enlightened people who put warnings on this. So for instance, Agustin Carsten from the Bank of International Settlement, a Mexican central banker, if you his quote is based on the widespread idea that a virtual entity cannot be trusted when it concerns financial stuff, financial matters. So it's something that is very important beyond the scope of this talk about crypto assets. Understanding the psychological bias when that prevent people from using digital interaction when it concerns finance. It's very useful for a company like SCOR, and when you think about underwriting, robo-advising, and so on. So it's very funny to see a guy like Agustin that put a lot of bite on the fact that virtual entity cannot work because it's difficult for people to trust this. And Jean Tirole, so someone that I know very well, so say, okay, Bitcoin is the pure bubble, an asset without intrinsic value. Its price will fall to zero if trust vanishes. Okay, Jean is right. But Jean is right as usual, but he's just defining money. Even money, standard money, public money has no intrinsic value. Its price will fall to zero if trust in the public money vanishes. This is something that has happened or is still happening in many countries. When public institutions become dysfunctional, you have when you have hyperinflation, like in Venezuela or Turkey, or when you froze the bank account, like in Argentina or Lebanon, there is a tendency to move to cryptocurrency. And it's very funny to constate that Turkey has a very high cryptocurrency ownership, 16 to 25, or that Argentina, effort to preserve their saving, has resulted in the nation hitting its highest demand for Bitcoin. So the value of crypto to people is not obvious. It's very dangerous asset. But some dysfunctional event like hyperinflation may encourage them to explore investing in crypto. And this is exactly the idea, the trade-off that I would like to explore in this talk. But remember that the comment of Jean is very right, it's right. But even a piece of public money is worth nothing without trust. So it's not, the problem with Bitcoin is not only trust. So just what could happen, why we are talking about hyperinflation. So just a definition, but it's to be short. Hyperinflation is when the price of goods and services rise more than 50% per month. And galloping inflation send prices up 10% or more per year. So hyperinflation is very rare, but it's because it's a huge event. Hyperinflation or galloping inflation have two main causes. It's the increase of money supply and demand pull inflation, when people have a lot of money and it's just a disequilibrium in the law and of supply and demand. But what you have to retain, to remember, is that money is very often printed when the fiscal policy becomes unsustainable, which means that if you put too much pressure, fiscal pressure on your country, on your citizens, so it's easier to print money. And by printing money, you devaluate your money, and so it's where inflation starts. So my point is that when you are a consumer, as we all are, we want to keep from paying more for goods tomorrow. So we want a mean of payment that does not depreciate. And in some sense, what we have to do, we have to seek a safe asset. We have to seek a way to store money, or by money, I mean a safe asset, something whose value tomorrow will be high enough to consume. And there is here the first problem that has been observed by Hayek in 1976, that there is no reason to let in the hands of the government the monopoly of distribution of money. And we can create a competitive system to supply a private money. But the question is, can a crypto asset deliver this ambition by Hayek? Okay, there are some people, and you can read in the news, that crypto can be viewed as a new digital gold, which something that is an alternative to the existing financial system. But this is not a good news for government and banks, because they have now an opponent, a competitor. So which means that they have no incentive to facilitate their adoption. And it's interesting to know that more than 40 countries banned Bitcoin. Okay, so there is this competition between financial system, which is the standard one with the central bank and government, and something purely decentralized. Okay, so what is exactly decentralization? It's something that it's not under the control of any government. And it's operated by a global community. Here, in the case of Bitcoin, it's a community of miners. And you have a code, you have a protocol. And what is very nice with Bitcoin in terms of monetary policy, the protocol has predetermined the monetary policy. You know that Bitcoin cannot be created. Okay, unlike governments that can print money. Here, there is a commitment. The number of Bitcoin is known. And there is another important property, is that it's difficult to tax, because it's possible, but it's difficult, because this system, this decentralized system, preserves anonymity. And you have to do transactions through a digital wallet. You need a key to do Bitcoin transaction, for instance. And therefore, there are two main advantages from a point of view of an investor, because it's difficult to tax, and you know that Bitcoin does not suffer from inflation because you cannot create more money. But the trade-off is from the fact that cryptocurrency are in general very, very highly volatile. And more than that, they are subject to sudden massive price swings. So recently, with the Telegram affair, with the Telegram problem, with there is one crypto asset, Pons, which lose a lot of value. I don't know. I do not remember exactly the number. I should have remembered this, but it's maybe on average, it's half of its value in one day. So this massive price swing is very dangerous. It's something that refrains people to invest in crypto assets. So to summarize, there is something that is a a buffer against inflation, but very volatile. So I would like to understand this trade-off. And to do this, as I told you, I will be very, very soft. I will describe a toy model. So something that we like in academia. So it's something that I will try to convey the main idea with the least possible ingredients. So for this, I propose a continuous time model. I have a government and many, many agents. So they are productive, and you can imagine the firms, but they are operating risky technologies. So for instance, you can imagine an archipelago with many islands, and on any island, you have a producer. And because I like apple, you can imagine that the good is apple. So you can eat apple, you can cut apple, take the seeds and plant apple to harvest apple tomorrow. So you have a risky technology. Why it is risky? Because if you plant seeds of apple, you don't know in advance how many apples you will have tomorrow, because it depends on the weather, on the climate, on the way you manage, you wet your apple tree and so on. So it's there is a moral hazard problem in the sense that only agents observe their output. Okay, so it's very important to know that they can they observe their output in the sense that you don't know in advance if they divert cash or goods or not. Money is used as a safe asset to buffer the risk. Why? Because we have a technology risk. So we have a risky production. And if you want to consume tomorrow, if you want to secure some consumption tomorrow, if you have only capital and if you invest capital to be zero because due to a bad weather condition, then you have nothing to exchange tomorrow for consumption. This is why agents make portfolio choice between risky asset and money. Government, on the other hand, funds public spendings with tax and seigniorage. So seigniorage is interest rate the firm pay on issuance of money, sorry. So we have a lot of agents, many agents. They all have a log utility, the preference is log, and they all have a discount rate of rho, so $1. So they don't put the same value, or you know what is a discount rate, and they don't put the same value of consuming one good today, and they need rho. One good tomorrow is rho good today. And what is this good? So you can imagine apple. It's something that can be consumed or invested. And we assume that the technology is constant return to scale. So if you invest one apple, you will get something proportional to this. Or if you put K apple in the ground, you will get something proportional to K. And what is important is there is an idiosyncratic risk. So each island on the archipelago, each farmer suffers from a production risk, but the production risk is independent from across agents, which means that there is a way to share risk by aggregating, because people are IID on aggregate, the risk is fully hedged by exchanging on the market. In some sense, if I lose something, if I need apple, I know that someone else, because he suffers from an independent risk, someone else will have apple, and I can exchange. Today I need apple. He has too many apples above his or her level of consumption, so there is some room to exchange. So each agent holds, so I have a problem with S, as many French. Each agent holds risky capital, KT, and public money, MT. So here I consider an economy without crypto, which means that I just have something, some capital, physical capital, say Apple, and public money created by a government through a central bank. So here, the idiosyncratic risk is very simple. We assume that the capital evolves as the drift Brownian motion. It's a geometric Brownian motion, if you want, because the logarithm is just a standard Gaussian. So BT is a Brownian motion. And the agent's wealth is the sum of the productive capital, KT, plus the value of money, but in goods. And the numeraire here is apples. So MT over PT is the value in apples of the quantity MT of public money. So in that interpretation, PT is the price of good in money at time t. Okay, so because my agent has log utility, he has to choose consumption and portfolio allocation between capital and money to maximize his utility. What happens? Okay. So what is the policy of government? So government chooses three terms, three ingredients. One is a fiscal policy. We assume that it implements a linear wealth tax rate too. So we have also a budget policy. So the spendings to pay the civil servant, for instance, is a constant proportion of aggregate capital. KT has to be capital KT has to be viewed as the sum over a cross agent of all the individual capital. It's a pie, it's a total production in the economy. And there is also a monetary policy. We assume that the growth of money supply is at the rate GM. So it means that each time you issue more money, the government gets GM times M as a seigneurage. So the budget constraint is very easy. To spend gamma KT, you need to finance the spending, and you have two ways to finance this public spending. One is to receive tax at a linear rate tau. This is the first term. And the other one is seigneurage is to be paid for a money issuance. Okay, so now we are back in, we have to remember your university lectures. So in finance, I suppose that most of you have seen the Merton problem. In finance, we know that how standard Merton problem explains how much to consume, how do you allocate between risky capital and money. And in the log case, as we assume in this talk, it's very, very easy to solve the standard Merton problem. So we know the optimal policy. The optimal policy say, okay, for the consumption, we have to consume a fraction rho of wealth. So I have my total wealth, capital plus money, and I consume rho times E every minute, every second, because it's a continuous time model, but it doesn't really matter for the interpretation. In terms of capital, I have to take a proportion X of my wealth to invest a proportion X of my wealth in the productive asset. So this is consumption, so dividend if you want. This is the reinvestment process, X times E. Okay. And what you can prove by solving the first order condition of our problem, but it's pure mathematics. I don't want to bother you with the details, but if we introduce the inflation rate, how the money decrease, the value of money decrease, the value of money in good, the value of a good in dollar or in euro decrease, pi, we can prove that by applying the first order condition that X the proportion of wealth you have to invest is the minimum between two terms, 1, and some ratio that is mu, the productivity of capital, plus pi, the inflation rate, divided by the volatility, the square of the volatility of the productivity. So it's a risk of production. So it's not a sharp ratio, but it's something that it's a ratio between productivity and something related to volatility. Okay? So in particular, if X is a fraction of wealth that you invest in capital, then for sure, 1 minus X is the optimal money holdings. So if you have at time t a quantity E of apples, you have apples in two forms: physical apples that you store somewhere, and apples in money. You can consume apple by buying or selling on the market with your money. And what you do, you take this E and you do the sum X times E plus 1 minus X times E. So it's pure linear algebra. And what we have, 1 minus X times E is the optimal money holding. It's a proportion of your wealth invested in the public money. So 1 minus X, it's very easy to see that it's a function that decreases with inflation. Okay? If you look at this formula, 1 minus X is something that 1 minus, so if X is lower than 1, if X is mu plus pi divided by sigma square, 1 minus X is something with, you have minus pi. So it decreases with inflation. The higher is the inflation, the lower is the quantity of money you own, you optimally have in your portfolio. But it increases with risk. The riskier the project, the higher is the quantity of money in your portfolio. This is the reason why we say that money is a safe asset, because it's a buffer against risk. You have a productive asset which is risky, so you don't know exactly how much you will have tomorrow. So in order to secure some consumption, you have to get a money in order to be sure that you will be able to buy apples tomorrow. So money is a safe asset, and it's very important also to notice that if you have money holding, which means that X is lower than 1, because remember that if X is 1 in this formula, K is E, which means that all your wealth is invested in production. Everything you earned from the past period is has been invested in the productive asset. And so if you hold money, it is because X is strictly lower than 1. And X lower than 1 means that mu plus pi divided by sigma square is lower than 1, which means that pi is lower than sigma square minus mu. So it's impossible. Pi is the inflation rate. If there is money holding, pi has to be bounded by sigma square minus mu. So you have limited inflation. It's a cap for inflation, this number. If not, if you have too much inflation, people don't want to hold money, which is not surprising, right? Okay, so now what is the equilibrium? So assume that agents hold money. So because they hold money, we have the relationship between X and pi given by pi is sigma square X minus mu, which is just a rewriting on the previous formula. Okay, first equilibrium. Inflation must be growth of money minus real growth. Okay, why? Because you know that the total supply of money MT should be equal to the price T times the total capital invested, which is 1 minus X over X, a constant, times K. Now you look at the rate of these two must be equal, and you have pi is GM minus G. So there is a relation between GM, which is chosen, it's an instrument of the government policy, and the inflation. So in some sense, by choosing GM for a constant real growth rate, the government fix the inflation. There is another equilibrium equality that says, okay, real growth, G, is productivity, mu, minus spending rate, gamma, so it's a payment of civil servants, minus the rate of consumption. And the rate of consumption is the ratio C over K. But remember that C over K is the same that rho E divided by X E. So you simplify the E, it's C over K, it's rho over X. So now there is a relation between G here and X that you can plug here. So using the relation between pi and x, the relation between pi and g, and the relation between g and x, you combine these equations, and what do you get? You get that agents holding of risky capital satisfy this equation. Okay, so the government choose the left-hand side, GM and gamma are in the end of the government. It's a political and fiscal, no, not fiscal, so it's spendings and monetary policy. And here we have the proportion of capital that will be invested by economic agents, by productive agents. Okay, so now we are back here. We set budget constraint, gamma, monetary constraint, GM. So these two instruments are part of the government policy, but by what we observed, it's totally equivalent to fixed X and gamma. Okay, so we prefer to, it's just a change of variable if you want, but we prefer thinking about an optimization problem with X and gamma as controls. And now what we have to solve, what the government has to solve is linear. So we consider a convex combination with weight beta, and we have to maximize over the controls. So what is this convex combination? This U here corresponds to the agent utility. So it corresponds to the Merton problem that the agent solves for a fixed pair X and gamma. So it's like a Stackelberg game. So the government says, this is my rule, so this is my budget and monetary policy. What do you do? I solve my logarithm, my consumption and investment problem, and I obtain a function that depends on X and gamma. This part is the government utility from spendings. Why? Because so we assume again that the government has log utility. So this log plus something can be viewed as log gamma kt. So at each time t, governments receive capital and they consume gamma kt. So there is a trade-off, and this trade-off is measured by beta. Weight beta is the weight you put on the productive agent utility, and 1 minus beta is the weight you put on the government utility from spendings. So it's a standard trade-off between private and public sector, if you want. So if beta is very low, it means that the government focus more on its utility from spendings. If beta is high or close to 1, if you want, so he's benevolent in some sense because the government is focusing on the productive agent's utility. Okay, so this beta is very important because it's a measure of the predatory or benevolent government policy. Okay, once again, we have, as we had before for the productive agents, we have here a control problem. We have to maximize over two instruments some quantity, and it's an optimization problem. So we look at the first order condition and we found a relationship. So the first relationship is that gamma must be equal to rho, the discount factor, times 1 minus beta. So remember that gamma is the rate at which you pay your civil servant. It should be equal at the product of the discount factor times the weight you put on the government utility from spending. So in particular, if beta is 1, if you are very benevolent, if you do not care about the public spending, you recover that gamma should be 0, right? So it's a good news. And this is the optimization for gamma. And for X, you can prove that the monetary policy, so GM, remember that choosing GM is totally equivalent to choose X. And in that case, we can prove that the monetary policy forces agents to invest the minimum between something that we call X star beta and 1. And X star beta has to solve this algebraic equation. But what is important is not the equation, it's the fact that X star beta is decreasing in beta. So X star beta is the quantity of wealth that is a proportion of wealth that you have to invest in production. So it's really investment. And by being decreasing in beta, it means that if you consider a benevolent government, high beta, so beta close to 1, we have low inflation because X will be very low, and X is mu plus pi divided by x squared, so pi will be low. If you are facing a predatory government, if you have a low beta, a government that like public spendings, you will have high inflation because X beta will be close to 1 or maybe more than 1. If beta is very low, X star beta overpass 1, and in that case, it's hyperinflation. We have no demand for money. The economic agents prefer to produce, to invest all apples in apples, but it's good because if you put more capital, you have more outcomes tomorrow, but it's a risky outcome. Remember that there is an idiosyncratic risk. So if you invest only in capital, the problem is that you have more production, but because it's risky, agents suffer from this. Government is better off because he has more production, so the basis for taxation is higher, so government has more taxes, so he's better off. But economic agents, productive agents are worse off because due to the risk. It is not because you produce more that you will, at the individual level, you will consume more tomorrow due to the risk. This is the reason why you need a safe asset, because you want to secure again consumption tomorrow. If you invest all your salary in Bitcoin and if Bitcoin crashes, you will not be able to consume tomorrow, okay? So here it's exactly the same. So if you invest everything in some company, I don't give a name to be polite, and if you invest all your salary, all your investment is centralized to one company, and the company goes bankrupt, you have nothing to consume tomorrow. Even if the total economy is growing. So now what happens? So to conclude, without crypto, it's very easy. To get low inflation, you need a benevolent government. Okay, so that's clear. And if you imagine that your government is if the government or politicians are more worrying about public spendings and less on the utility of productive assets, then you have a high risk of inflation and the money becomes worthless. So the question is, what happens if you introduce crypto assets? Okay, if you introduce crypto assets, what you have in your allocation now, you have three choices. The first one is how much capital I retain to invest. The second choice is, as usual, how much public money, the second term is how much public money I get, I keep. And the last one is how much private money I keep. Okay, so this is just a notation for the pure notation, because this ratio at the optimum will be constant, but no matter, you can forget this for a while and looking at the three possible allocation of capital, of wealth. I keep Apple to invest. I exchange Apple against public money. I sell Apple on the standard market, or I sell Apples on the private money or on the Bitcoin market. So by symmetry, PT is the price of good in public money. Hat PT is the price of good in token or in crypto asset. But you can repeat exactly the same reasoning. This is where there is a kind of magic in the Merton problem, that you can repeat exactly the same. That by saying this, I would like to say that in fact, in this setting, adding a new investment opportunity does not change anything in terms of doing the computation of the optimal policies. So what we have to do, we have to say, okay, now I had something, I had a new asset, but I want to trade off, because if it's a better asset, for sure I have to invest in it. So what is the trade-off? We have decided we have decided to model the extreme volatility of crypto asset by saying, okay, as a huge approximation, we will assume that there is a Poisson process with intensity lambda. At the first time of this Poisson process, tokens or Bitcoin or private money become worthless. It's a very strong assumption, because you have something that is the value of this is purely deterministic, but at some point in time, it becomes zero. So it's a harsh way to model volatility, but it's just to model the trade-off between public money with a risk of inflation due to a government intervention and volatility of private money, which at the extreme modeling we chose is represented by this first time of the bankruptcy time of modeled this way. So what do we have? So we can justify this by, okay, maybe there is a belief that Bitcoin is worthless, so it's self-fulfilling belief, or there is a technological problem, large-scale problems have occurred on the network. So there are references to justify this, but it's not, no matter the justification, it's you can see this as a simplification. So imagine that the volatility is huge because it's something deterministic, and at some point it becomes zero. So when the Poisson process occurs, when the token when the tokens become worthless, so for sure the public currency price jumps to PT plus, because you have now the only possibility to buy Apple is to use money, public money, so the price will increase. Okay, so we repeat exactly the same argument as before. And by solving the problem, and I wrote here only the first order condition, we can prove that because the crypto are here, so now the government cannot set inflation as high as it wants. There is a ceiling given by square root of rho plus lambda divided by sigma. This ceiling say, okay, x, remember, is a fraction of apple that you have to invest for tomorrow. Okay, and this quantity, this fraction, cannot be higher than this level. And this level is an increasing function of lambda. So if x is greater than xc, then you have too much inflation. So in that case, agents do not hold public currency, hyperinflation. Okay? But the constraint is, so without crypto, remember that x has to be lower than 1. So if I had a constraint x lower than some level xc, if xc is greater than 1, you have no supplementary constraint. So what happens if xc is greater than 1, which means that if lambda is large, for instance, but if xc is greater than 1, this constraint adds nothing with respect to the former constraint x lower than 1. So in some sense, if the probability to crash is very high, xc is greater than 1, so large xc, and crypto has no discipline effect on monetary policy. In some sense, central bank or government say, okay, there is an alternative, there is an opportunity to invest in crypto, but there is an opportunity to invest in crypto, but okay, the probability that the value of this opportunity falls to 0 tomorrow, it's almost 100%, so nobody wants to invest on it. And this is the reason why this alternative has no effect on the monetary policy. The government choose exactly the same policy with or without crypto. Il va pas en merde. Okay, sorry for the phone. So what's on the other way? We say, okay, now the government does not want to set inflation too high with crypto, because due to this constraint, okay, if the optimal x star, the one that satisfies the first order condition for the government, is lower than xc, okay, it means what? It means that you satisfy the constraints, so you have enough with public currency to buffer your risk. So there is no need to invest in Bitcoin or in crypto assets. Okay? So in some sense, if at the equilibrium, the government is benevolent, the government cares more about productive sector than public sector, in some to sum up. So in that case, it does not like the government does not like inflation, or does not put inflation at the equilibrium too high, and there is no need of crypto. But on the other hand, if the government is predatory, if he put more weight on the public sector than on the private sector, the predatory government would like high inflation, as we have seen before. But now, if you have high inflation, agents now hold capital, but the capital is limited by xc. So if xc is lower than 1, then you will have capital at the equilibrium. Agent will have capital, public currency, but also private currency. Due to the fact that, okay, if you put too much inflation, you are decreasing the value of public money. So I know that it will cost. Pas compris. I am very demanding. Sorry. I'm very asked. So if the benevolent government, sorry, I was here. So predatory government who impose high inflation, it reduces the value of public money. Okay. Therefore, the alternative of investing in private money is higher, and this is the reason why. Except if lambda is too large, because if lambda is too large, we have seen that there is no constraint. So if the probability of a crash is not too high, and if the government is predatory, then you have to use crypto asset to buffer risk, and in some sense as a safe asset, because the value of this asset is high enough to secure consumption tomorrow, which is something counterintuitive, I agree, because it's very volatile. But there is a competition, there is a trade-off between inflation due to government intervention and volatility due to belief on the Bitcoin market. And this is the tension between these two negative effects may explain why it could be a good idea to have cash in your Bitcoin in your portfolio. So I am right on time, sorry. Okay, so to conclude, what I would like you to remember from this talk, which is again a very, very academic talk, presenting a toy model just to give you idea. So money is clearly a safe asset to buffer productivity shocks. Each agent would like to consume tomorrow. So in our model, consuming is just eating apples, okay? But if you invest all your wealth in production, and if the production is destroyed by bad weather, you have nothing to consume tomorrow. So this is the reason why you do not invest all your wealth in productive asset, but you keep safe asset in order to secure consumption tomorrow. So it's very standard. And the question is, what type of safe asset you can use? And there are two safe assets. There are the public money that is created by institutions, public institutions, and private money that is created by some distributed ledger, distributed market. Okay, and the question then, is it optimal to use one of the two, both of them? This is the question that you can ask yourself. Okay, if you have no other choice, if you have only public money, okay, you are suffering as a productive agent if you are in a country where the government put a lot of weight on public spendings. Because if the government put a lot of weight on public spendings, you have a high risk of inflation, okay, and you extract rents from agents. With this hyperinflation, you force them to invest in productive assets, but because the productive assets are risky, the agents are worse off, even if the government is better off. So it's an equilibrium where hyperinflation creates more production, but at the individual level, the risk trade-off this growth of the economy. But when you have crypto money, crypto asset, when this cryptocurrency competes with public money, there is another buffer. Government cannot set inflation too high, because if the government set inflation too high, the agent will abandon public money for crypto. Okay, even if the crypto is very volatile, because in our example, it's super volatile because it can be worthless after some random time. So to be more specific, if the government is still benevolent, crypto is useless. because government do not want to inflate too much. Okay, so because at the equilibrium there is no inflation, there is no need for private money. But if government is predatory, then the competition with crypto forces government to lower inflation. So in some sense, only the possibility for agent to invest in crypto forces government to lower inflation. So this is the main message of this presentation. And I think that because we have 20 minutes, I think I would stop here. And thank you for your attention.
Thank you so much, Stéphane. But I think your conclusion is very clear. And I think that people have well understood your conclusion, because we have a first question from Lars Pral. I don't know if Lars would like to ask his question himself, or if he prefers myself to.
No,
you can read it.
I see
you
Lars.
See
so
yeah.
I can.
Nice to meet you, Lars.
Yeah, thanks for the talk. I'm not. I for sure did not follow all the macroeconomic equilibrium equations, etc. But my question is more in general terms. Does it really have to be a cryptocurrency that provides an alternative investment opportunity or a safe haven, or wouldn't an independent public currency do the same job?
No, it's a very good question. It's something that so this is the reason why I put digital gold at some point in the slides, because gold played this role. And you have to remember that gold was very volatile at the beginning, and 2 or 3 centuries ago, when you exchange against coin. And you're right that what we are interested in this crypto asset, it's the characterization of crypto asset is they are free from inflation, but you can say gold, but it's free of public intervention. So if you are in a country that is whose government is very, very predatory, who put a lot of weight on public spendings, it's an alternative for you to buffer your risk, your idiosyncratics coming from your production, and also the risk of having a public money that declines. But where you are right, you can also imagine that you can use gold or some other asset that as a safe haven, as you told. So this is something that this is a criticism that I understand, because what is unclear is that is gold a mean of payment that is easier. Can you imagine that I will pay my bread in gold? I'm not sure. But nothing prevents me from paying my bread with gold. But it's something that is unusual. Probably with Bitcoin, it's difficult nowadays. But in San Salvador, it's possible, and we could imagine that if people trust in the network, in the distributional ledger, I think there is a possibility to pay if there is a reduction of waiting time for the transaction or the transaction fees. There is a possibility to pay in Bitcoin with a credit card in Bitcoin, a digital wallet, physical digital wallet. Maybe it's but there is no other reason to hope that. No, it's not a hope, but to justify the use of Bitcoin as an alternative for public money to be a safe asset. I agree that it's not obvious that it's the only safe haven. It's again a very good question.
Okay, maybe I will plunge the question of Lars, but before that, just answering a question of Michael Clark, who asked if the presentation will be made available. I let you answer, Stéphane.
Yes, sure it is, because I sent it, and I think that the presentation has been recorded, so you have everything is available.
On the website of the foundation.
Yes, except the paper, because we have to think about
it's
some concern, like the one from Lars.
Yes, and it's not yet finalized. Just a question, but of course it's a good answer, and of course some public money, other public money may be playing the same role. For example, in Argentina, people, or in Brazil, people are investing in dollars. In fact,
yes.
the dollar is, at least in relative term, playing this role. But then I have a further question, Stéphane. You can convert your pesos, your Argentinian pesos in dollar or in gold, as long as the government don't forbid it.
Exactly.
And it has an ability to control capital movements, which is well known, is the capital movement control, which limit. What do you think on crypto money, crypto assets, and cryptocurrency? How much can government control cryptocurrencies?
So I think that some answer from a specialist of the network will be a bit better than me. But I think that it's the thing that I know nowadays is the fact that so you need only a keys, but you need a platform to exchange. I think that you can. When I said that people ban Bitcoin, it's a ban for the means of payment within the country, right? But it's not. You cannot prevent some individual from your country to open some account in some platform with. So it's difficult to control. So it's so the access of Bitcoin is. I think it's difficult to control by government. Maybe there is an attempt to do this, but I'm not really sure that I am competent in this question.
You have maybe, Stéphane, I have in mind two arguments on that point. The first one is that you are using internet, and as you know, internet is more or less controlled. Probably any transaction is going through internet connections in the US, for example. Probably not in France, because we are in a small country, for example, for France, but for the US, most of the information exchanged through internet at one point in time are going through conduct which are based in the US. For example,
yes, you mean for the cloud, so for the storage.
Yes, for the cloud, and more generally, all the internet connection are using at some point in time a connection in the US.
So your interesting point is maybe because if you in my presentation, I say there is a competition between private and public money. So it's the ambition of Hayek, and it's not mine. And the question is, maybe a country like US is so powerful that it will find a way to distort its competition by preventing US citizens from having an easy access to Bitcoin exchange.
Yes. Or even
I'm not sure that we are at this point, but maybe if the competition will become fierce, maybe there will be some regulatory policy of that kind. There is another alternative, is to create digital money, a digital central bank money. So there is another an alternative, but this is something far beyond the scope of what I have presented. Now, the question, the very funny thing is, okay, how is it possible that such a volatile asset be considered as a safe asset? This is where it's funny, and it's because it's a trade-off between. I do not believe in my government. I believe that my government is doing a bad policy, and I am expecting high inflation. So I don't want to keep my public money. So the question, I have to find another an alternative. It could be gold, as Lars mentioned. It could be dollar if I am in peso, but there is this problem of forbidden transaction between countries. So as long as it's possible to open a Bitcoin account on some platform, I think that this alternative has to be considered. I do not claim that, as I mentioned at the beginning, at the outset of my talk, I am not able to predict anything about the price, the collapse of the Bitcoin market. I just want to say that having a proportion of your wealth in some crypto asset could be a good idea for diversification and for the fight against inflation. This is only what I am mentioning. And in particular, you can, for instance, be interesting by buying bonds from San Salvador that are backed by the price of Bitcoins, which is something very weird, but it exists now. So it's again a trade-off between inflation and the belief that in the long run, Bitcoin price will increase.
But otherwise, Stéphane, there are other assets that can protect us against inflation. For example, if not at short term, at least at medium term, equities, stocks are protecting against inflation because they are more or less indexed on inflation, and therefore they are less volatile than, for example, than the Bitcoin.
Yes, you're right, but the problem is exactly as I mentioned in the talk. The sigma is positive, so you have a risk in the production. So once again, you can invest in equity.
Then a portfolio, not one stock, but of course,
yes,
a diversified portfolio.
If you have a diversified portfolio, but if you have a diversified portfolio within the same country, so I don't. If it's a well-diversified, internationally diversified portfolio, maybe you do not have to care about Bitcoin. But this is more a question for asset manager. So people that are involved every day on this type of question, I don't know exactly what to say about this. But where what is very important to notice is, again, when you have this productive asset, you can invest again in the productive asset. Like you can buy a stock of what you want, but there is a risk, and the value could be less than expected because there is something that you don't expect. You did not expect ex ante. So for instance, you can invest in some startup being very and at some point there is no return. And this is so you're right that at the level of a company like SCOR, you don't have only an archipelago of farmers independently distributed, so you can diversify across equity and across firms. You're right, but here it was more the question of at the end, when you pay dividend in euro, when you consume in euros, so if the value of euros decline, is it possible to have an alternative for this expectation of inflation? And so there are other ways to fight against inflation. The central bank can play with the interest rate. In our model, minus pi can be viewed as the interest rate. But for sure, at the equilibrium, in our toy model, you cannot do what you want because you have three instruments for the government, but they are linked. So by choosing two, the third is forced. So you can do whatever. So it's very important to understand this in a toy the simplest model you can imagine before implementing this in real life. So this is. But once again, it's maybe a point by academics, but
okay.
So in terms of, I'm not the one that will recommend something to asset manager, but like this. But clearly, having a short proportion of of your portfolio in crypto assets, well diversified. Forget the short-term fluctuation, because if every time you see up and down movement, very erratic movement, you panic and you buy and sell, maybe it will be costly with the transaction fees. But if you say, I will put part of my wealth in crypto asset and I will leave it during a medium or long period, it's a way, according to our paper, it's a way to offset the risk of inflation by, again, by if you believe that your government will be a predatory government. And this is also an assumption. I don't pretend anything about our government, for instance.
Yes, it's clear. Just remark that the question is the entry point, because you have not to you have to be careful not to enter the market of the Bitcoin or any other cryptocurrency at the top of the cycle of its fluctuation, but at the bottom, or at least in the middle of the cycle, probably. Maybe let me look. Are there, please, you have the opportunity to ask question. I think it's a very important question, because people are using Bitcoin, and they are more and more using Bitcoin. The SEC is allowing the use of Bitcoin in diversified portfolio, and therefore the question is for us, what do we do? Do you have questions there? You have here an opportunity to ask questions on a more theoretical background, and I think it's very interesting what Stéphane just learned us, and I think it's very stimulating. Please don't hesitate, raise the hand. I don't see other questions. Yeah.
May I say something? I don't know if there are people from the behavioral group where we had connection with. There is also, I think there is a question that comes from the Augustine quote about this psychological bias, playing with something that is immaterial, intangible, virtual, call it as you want, when you are doing a transaction. So even if you are doing algo trading, so you have many virtual exchange, but by virtual is no digital exchange. But at some point, people are more willing to sign financial contracts with people they can look at, or they can. And this is something where I would like also to have the point of view of people in the daily business of underwriting. If there is a hope to use this digital revolution to change the way to model to implement underwriting in insurance, or to implement asset management. This is something that where I am curious about the daily practices of a company like SCOR. So if someone is interested by chatting about this particular aspect of what do you think about psychological bias of having a robot advising for management, or for underwriting, or for insurance choices. So I would be very happy to chat with him or her. This is something that I think it's very relevant nowadays. I did an experiment with ChatGPT. I recommend this experiment. So you ask ChatGPT to do a multiplication of two numbers with 4 digits. So choose your favorite two numbers with 4 digits, and you ask ChatGPT to do the multiplication. So it gives you a result. And now you ask, in the prompt, you ask many questions. And after this series of questions, you ask exactly the same question, multiply the two 4-digit numbers, and you will not have always the same number. So the way you speak to the ChatGPT influences the answer. And this is something that is very weird. Okay, so there is some kind of bias in the way you will interact with what we call generative AI. So I think that it's very important before going to any digital revolution to understand what could be the psychology of a machine or how the machine works. And this is, I think it's important for robo advising or something like that, if you are interested in this type of implementation.
Of course, and your remark is generally speaking accurate for any artificial intelligence simulation, etc. Just perhaps a last question, because it's an important concerning the volatility. How much do you think we can imagine speculative attack on Bitcoin? Because one of the main risks of any asset, any currency, is speculative attack.
Yes, but if you look at today's, it's
Yes.
exactly the after Powell intention to reduce the interest rate, the price of Bitcoin moved from in one day from I don't know, $58,000 to 62 or 63 in one day. So there is really a movement. So unlike the speculative attack, is really a movement that you have people are betting on Bitcoin each time they see information about the public.
Yes, but there it was probably a bet on inflation. That is, if
but it's contrary. Yes,
the Fed would not have reduced the interest rate, they would have reacted differently.
But the question is, if they are fighting against inflation, why don't speculators attack the Bitcoin, saying, so the Bitcoin now is too high and I have to sell it? I don't know.
It's no more as much protective as I thought before. Of course, it could have been the normal reaction of reallocation of the portfolio.
Yeah, but this is something that I'm not very clear about this. I'm not able to explain short-term fluctuation. I think that if you increase the mean of the mean of payment, so if you increase the possibility to do transaction with Bitcoin, for sure you will lower the volatility. I am almost sure about this, because it will become something. So you will still have volatility, because dollar against euro, you have volatility, but you will decrease this volatility if people imagine Bitcoin as an alternative to do payment. I do not see why it will be attacked more than other currencies.
Yes,
but maybe I'm wrong. It's just a feeling.
Okay, I think we are just at the end of this webinar. Stéphane, I would like to thank you so much. It was an insightful and brilliant and very stimulating webinar. I think as your conclusion and which are part of your recommendation, if I can give them a name, it's something we have to think twice about it. I think it's currently even inside SCOR debate. And let me also thank all the participants and also those who have asked a question. And again, thank you so much, Stéphane.
Thank you. I would like to thank you. And again, do not hesitate to be in contact with us.
Yes,
I know that in your daily business you are very, very, very busy. But if you have question, if any of these 40 people ask question, they can pass through the intermediary.
Yes, and we will leave your address.
Exactly. So say thanks a lot and have fun and have a good day.
Goodbye. Thank you so much.
Merci.